Thank you for tuning into the Equity Channel, where we provide the highest quality stock market analysis to individual investors. Our goal is to help you improve your returns by keeping you up to date with everything you need to know. What helps investors beat the market is information and knowledge of how to use it. We'll provide you with both. Before we get started, be sure that you subscribe and turn on your notifications, because every time we drop a new episode, money is made.
Welcome to the Equity Channel. Let's get right into it. Some potential warning signs for investors as we look at the economic outlook for 2025.
Yeah.
What are we kind of seeing on the horizon?
Right. I think one of the key indicators that we watch closely is the January Barometer.
Okay.
And that looks at how the market performs in January to give us a sense of where things may be headed for the year.
And how did January shape up?
Well, 2 out of the 3 components, the first week, last week, and then the full month, actually closed negative. So that's a signal to proceed with caution.
Okay.
Yeah.
And what contributed to that negative close?
I think President Trump's announcement of tariffs on Canada, Mexico, and China definitely played a role.
Okay. Interesting. We also got the January Purchasing Managers Index, or PMI.
Right.
And there were some mixed signals in that report.
Absolutely.
What did we see there?
So the services sector, for instance, reported its lowest output since April 2023. But at the same time, we saw a 31-month high in job creation.
So more jobs, but less productivity.
Exactly.
That seems a little counterintuitive.
It does. And it points to a potential problem, inflationary job growth.
Okay.
So when productivity falls, businesses need to hire more workers just to maintain their output. And this increased demand for labor pushes wages higher, which can add fuel to the inflation fire.
So even though job growth is typically seen as a good thing,
Right.
in this case, it could be a sign of some trouble brewing.
It could. And it's particularly worrisome, I think, in the services sector, which makes up, a significant portion of the overall economy.
Right.
The PMI report also revealed lower confidence in future business conditions within the services sector.
Okay. So not all good news coming out of that PMI report, though.
No, there were some bright spots.
Okay.
Manufacturing, for example, actually showed some signs of optimism.
Okay.
But given the size and importance of the services sector, that slowdown definitely deserves attention.
And the Atlanta Fed seems to agree with that assessment. They've already revised their GDP projections downward from 3.9% to 2.9% based on those services PMI figures.
Right. And this potential for lower economic growth, of course, has implications for investors.
Right.
We could see lower than expected S&P 500 earnings this year.
So what's the takeaway here for investors who are trying to navigate this somewhat uncertain landscape?
I think selectivity is key.
Okay.
Rather than, just jumping into the entire market, focus on individual stocks that offer the best value.
Right.
And it might be a smarter strategy to hold off on buying the S&P 500 until, we see a correction or a bear market.
A bear market.
Mm-hmm.
Are you suggesting that that's a real possibility for 2025?
It's definitely our base case scenario at this point.
Yeah.
We're anticipating a slowdown in growth, a Federal Reserve that's likely to keep raising interest rates,
Right.
and potentially, a weakening labor market over the long term.
That weakening labor market is a concerning thought. What data points should investors be watching for to confirm that trend?
Keep an eye on Tuesday's job openings report.
Okay.
I think that could provide some insight into whether, this persistent inflation is starting to make it harder for people to find jobs.
It sounds like we really need to reevaluate our investment strategy in light of all these economic signals.
Absolutely. And that starts with adjusting our S&P 500 buy target. We've lowered it from 5,700 to 5,000.
What prompted that adjustment?
Well, a couple things. One, FactSet has revised their earnings projections downward, and we saw a forward PE ratio of 22 last Friday.
Okay. So if the S&P 500 does reach 5,000, would that be a signal to maybe start buying the whole market?
Potentially. Hitting that level would definitely trigger a reassessment of our strategy.
Okay. So to be clear, the main scenario that you're predicting for 2025 is either a bear market or at least a deeper correction.
That's right. Of course, this prediction hinges on, forward earnings projections for the S&P 500.
And those could change.
They absolutely could. And if they do, we'll adjust our forecast accordingly. But right now, our best case downside scenario is 5,600 for the S&P 500.
So in this potentially volatile market, what can investors do to mitigate their risk?
Well, one thing to consider is adding inverse products like SQQQ or VIX to your portfolio.
And what exactly are inverse products?
Think of them as a form of insurance for your portfolio.
Insurance for my portfolio. What does that mean?
Yeah, so essentially, inverse products are designed to move in the opposite direction of the market or a specific asset.
Okay.
So if the market goes down, they go up, and that helps to offset your losses.
So it's a way to kind of cushion the blow of a downturn, especially if, we are headed for a bear market, as you're predicting.
Exactly. It's a way to stay invested, but also, protect yourself from that downside risk.
Okay, that makes sense. You also mentioned earlier this idea of inflationary job growth.
Right.
Can you explain that a little bit more? It seems a little paradoxical to me.
Sure. It might sound counterintuitive, but you'd think more jobs would always be a good thing, right?
Right.
But if those jobs are being created because productivity is falling, meaning workers are producing less output per hour, it can actually contribute to inflation.
So companies are having to hire more people just to keep up with demand.
Right.
And that's driving up wages, which feeds into inflation.
Precisely. And as we discussed, this is especially worrisome in the services sector, which is such a huge part of the economy.
Right. You also mentioned the Federal Reserve's likely bias towards higher interest rates. Why is that something investors should be concerned about?
Well, the Fed raises interest rates to combat inflation, as you know, but higher rates make it more expensive for businesses to borrow money, which can slow down economic growth. And slower growth can eventually lead to job losses. It's a tricky balancing act for the Fed.
So it's a bit of a catch-22. They need to raise rates to control inflation, but doing so could actually hurt the economy in the long run.
That's the dilemma, and it makes investing in this environment even more challenging.
Let's circle back to your revised S&P 500 buy target of 5,000.
Okay.
Why such a significant drop from the previous target of 5,100?
Well, the revised earnings projections from FactSet are a major factor.
Okay.
Analysts are now expecting lower earnings growth for companies in the S&P 500, which, directly impacts the index's value.
Right. And you mentioned the forward PE ratio.
Right.
Remind us what that is and why it's important.
Yeah, the forward PE ratio is basically a way to measure how expensive a stock or an index is relative to its expected earnings. Okay. In this case, the PE ratio of 22 that we saw last Friday suggests that the market, might be overvalued.
So a lower PE ratio is generally better because it means you're paying less for each dollar of expected earnings?
That's the general idea. Of course, it's just one metric among many,
right.
And it's important to consider the broader context. But in this case, it does reinforce our cautious outlook.
So if the S&P 500 does hit that 5,000 mark, you'll reevaluate your strategy.
Right.
What factors will you be considering at that point?
We'll be looking at a range of things. Updated earnings projections, market sentiment, overall economic conditions. If things are still pointing towards a slowdown, we might shift our focus from individual stocks to buy in the broader market.
You've painted a somewhat sobering picture of the economic landscape for 2025.
Yeah.
For investors who are feeling a bit uneasy, what's the key takeaway?
Stay informed.
Yeah.
Stay adaptable, and don't be afraid to adjust your strategy as needed. The market is constantly evolving, so flexibility is key to success.
So incorporating those inverse products that you mentioned could be a way to kind of add that layer of protection and flexibility to a portfolio.
Exactly. And it's not just about mitigating risk. These products can also offer opportunities to profit in a down market, but it's crucial to understand how they work and the risks involved.
Okay. So we've covered a lot of ground here. Let's recap the key points for our listeners.
Okay.
You're watching the January Barometer, which flashed some warning signs.
Right, and we're seeing some concerning trends in the PMI data, particularly in the services sector.
Right.
Inflationary job growth is a potential problem, and the Fed's likely move towards higher interest rates could have a ripple effect on the economy.
So your base case for 2025 is a bear market, or at least a deeper correction, which is why you've lowered your S&P 500 buy target to 5,000.
That's right. And we've highlighted the potential benefits of incorporating inverse products into your portfolio to manage risk and potentially capitalize on a downturn.
But it's important to remember, all of this is based on the data we have available right now.
Absolutely.
Things can change quickly in the market.
New information is constantly emerging. Staying informed and adaptable is crucial.
Speaking of staying informed, we'll continue to monitor these trends and provide updates as the year progresses.
And we encourage you to do your own research and stay engaged with the market.
The more you understand these dynamics, the better equipped you'll be to make smart investment decisions.
Yeah. Knowledge is power, right?
Yeah.
Especially when it comes to investing.
Absolutely. The more you understand, the better decisions you can make. And remember, investing is a marathon, not a sprint.
Right. We've talked about, a potential bear market and all that, but what if things turn out better than expected? Well, that's always a possibility. Our best case downside scenario for the S&P 500 is 5,600. And if those forward earnings projections for the S&P 500 improve,
right,
we could even see the market move higher from there.
So there's still potential for upside even in this, cautious environment.
Absolutely. And that's why it's important to have a balanced approach, Don't let fear paralyze you.
Right.
But also don't be reckless.
It's all about, managing risk and being prepared for different scenarios.
Precisely. And remember that we're here to help you navigate these complexities. We'll continue to provide updates and analysis as the year progresses.
We're all in this together. We want to see our listeners succeed.
Absolutely. We're committed to providing you with the insights and tools you need to make smart, informed investment decisions.
So as we wrap up, what's the one key message you want our listeners to take away from this episode?
Stay informed, stay engaged, and stay adaptable. The market is constantly evolving, and the more you understand those changes,
right,
the better positioned you'll be to achieve your financial goals.
Great advice. Thanks for joining us today.
It was my pleasure.
And for all of our listeners out there, be sure to subscribe to the Equity Channel and turn on notifications.
Every time we drop a new episode, money is made.